Hello, this is Todd Foster, and this is your market wrap for the week ended October 12th, 2018. Well, October is certainly living up to its reputation this year, with the markets having a sort of a mini crash this week. I think the Dow at the lows was down about 1,300 points off the high, so that was very quick, very furious. As you know, we've been talking about a bear market for a year now. And that we were running out of runway, we were in the late innings, blah, blah, blah. We thought we could get to 3,000 on the S&P. We did get to 2941, so that's close enough. Now, I wanted to pull out this chart because I was just going through all my charts this week, a lot of looking at some of the longer term stuff to kind of just look forest from the trees. And this chart popped up. I did this chart, I think at a seminar, a United Retirement seminar, and I think it was like, I don't know, like 6-7 years ago or something like that. But when I looked at it, I said, whoa, it's like really close. I did adjust this, you know, the 2941, these Fibonacci numbers, a little bit. I had it up around 3,000, like we've been talking about. But man, I just adjusted it, and this just seems, you know, really where we are right now. It just seems very complete. Oh, this is a monthly chart, folks, okay? This is the S&P on a monthly basis. So this is the top in 2000. With the big drop. I think it was about 50%. Then we rallied back up, remember? And then we had the '08 crisis with the real estate, and we dropped 50, oh my God, 60, almost 60% into that low. And now we've been in this great, the longest bull market ever in the history of the stock market. The velocity that we broke down, so I just wanted to show you this, that we've been kind of thinking about this. And even these tags I wrote, real global growth, I'm going to talk about interest rates, and I think, and I was talking to you guys about the Italian debt, the Europe debt, how the emerging markets can't handle the higher interest rates. Maybe that's what, and remember I said that could be what this bear market's about. Maybe that's what brings us down here, is like a global reset. All right, Europe's got problems. They need a one central bank. You know, they have the ECB, but all the other countries do their own thing. They need to square that away. They need to clean up their debt. And we'll see if the emerging markets come into a problem. But if we have a nice washout here over the next year or so, if this is the bear market, and I'll show you, there may be a chance we still go up next year. But again, we're still getting very close, okay? But even if when we get this correction, if it is kind of a clean the pipes out, you know, like just the kitchen sink goes in, this might allow for this real global growth, inflation, higher interest rates, things like that. And we're going to actually see the world index go up, everything kind of go up together. Because as I've been telling you guys, I'll show it to you here, the international markets have really been rolling over. This is China, okay? Germany just now executed this pattern this week. I've been tracking this for months. I haven't changed these lines. And look what happened. Look at this is like a picture perfect top to the bear market. If this to the bull market. This is it formed since 2017. It's taken over a year to form. Remember, tops are a process. They take time to kind of develop. So that's why maybe we're still going to see a little bit more jostling around in our S&P. But look at this is a year in the making. This head and shoulders, and look what happened this week. We broke down. Now maybe it's going to come down a little, kind of test. But man, now the DAX has to get over this. And if the DAX can't get over this, I think it's the third largest economy in the world, fourth, something like that. Very, very important. And seeing this topping formation and the breakdown this week, it's not even oversold. It's concerning, okay? So let's just get into our S&P. We have very limited exposure in international, and that was a smart move. So this is what I'm thinking here. Remember we were starting to talk about this NYSE. People that follow this report, I'm going to have some new people on here because people that don't watch it normally, but people that do watch it all the time, you know I've been showing you the NYSE was concerning me. I said, why isn't the NYSE, which is 5,000 stocks, all breaking out like the S&P and the NASDAQ and the small caps? Why isn't it going up here? And I couldn't come to grips with it. Well, now it looks like this was right all along. So I had this as an A, this was all a B, and we're going to head down into a C. And that was going to form that fourth wave that we talked about. So I have that on the charts now. on the S&P, I did confirm with some Elliott wave experts that this is valid, where we could have an A and the B could come all the way up here because it's a stronger market, which obviously the U.S. was, and we can still have this C down. So, and that would match up with the NYSE, all right? So I'm showing you that given this velocity we had here, we're probably not at the lows yet. We're gonna have to do some more downward action, whether it's all the way down here or this red count that gets really ugly. You have to be prepared. This is not over yet, okay? So we're gonna have to see now more trading and how this thing develops into this really important support level. You see the support level right here? The January or the February lows, right around this 2550, 2600, right in here. That's where I think we're headed, okay? That could even move the 4 over here. But we're gonna have to see now what the rally looks like after this completes. So from our standpoint now, if this was in fact the top of the bull market, we need the first leg down to trigger all of our long-term charts, our long-term monthly charts and our long-term signals. And as you can see here, these are some of our signals. We haven't triggered yet. We'd have to drop below this blue line, okay, on a monthly close. So not there yet. This one is on a bear market. If we close where we are now, this would be triggered at the end of the month. This one is not triggered yet because it's going to need these to cross, and they haven't done that yet, so we need some more time there. And the same thing here. We need to close below this blue line and also have this MACD below the 0 line. So as you can see, things are peaking up. See this negative divergence? Look at that. Terrible. But we need to see these charts all trigger. Now, if we go down to this 2600-ish area, it's going to make a lot of those charts start to really get close. And then we're going to have to see what the next bounce looks like. If the bounce is corrective, like, corrective means trying, goes up, but it's trying, and it comes down, and it goes up, and it's trying, and it's going up. Something like that, we're going to need to get off here, okay? And this is where we'll do a lot of selling. We did for some of our active models, did raise some cash last week before this started, right around here. So we're in a better position than even we were in 2008. 2008, we waited for the first big drop, and then on this is where we unloaded. This time we got out of a little bit. It's a little bit better. We didn't sell anything in 08 before this big drop. So I feel like we're already doing a little better if this is going to be a bear market. So that's exciting. But we're going to have to see once this wave completes, and like I said, be prepared that this is going to come all the way down. But once we get that rally, and how we're going to know it's the real deal, like today was not the real deal, is we're going to see a very strong reaction off here, and we're going to start to hear from the people on TV and media, oh, the worst is behind us, the correction is over, that kind of thing. And if we start to see this corrective, we're going to get off. All right, we're going to get off the train. So remember, bear markets don't go from here all the way down here in a straight line. Could it happen? Yes. Anything is possible, but it's not likely. More likely is see these stair steps up, and here we didn't do that. But even in a bear market, we're going to have a stair step 2, 3, 4, 5. Okay, and where people really freak out is this one, the 2 to the 3. So we want to be off, kind of in a defensive posture or bear market portfolio somewhere in this vicinity. And this is why we're also not going to do anything further, okay? Because we're guessing here that this is not going to play out. We need to actually see what this low looks like and see what the rally looks like to determine, in conjunction with those other indicators, which are long-term monthly signals, if those start flipping, they start getting closer. We've already done this. We're rallying up correctively. That will be enough evidence for me. And we're going to have to get off, and hopefully we avoid what's going to come next on this red count. If we're just going to head straight down here, maybe I should put this 4 closer to the 1. That probably makes better sense. I was doing this morning, but this probably makes a little bit better sense like that. So once we get this low in here, we're going to have to see. Now, if it's a very impulsive, very strong, it should be, up. and then down, but then up strong again, and then down and then up strong again, meaning it's not letting anybody in, and we start to get buy signals as we're coming up, then we're going to be able to know that this was a 4 and we're heading still to new all-time highs in 2019. I have things on both sides, so I really need more trading at this point. We have stuff for a top. We have a fully valued market, longest bull market in history, a Fed that keeps raising rates, international markets that are falling apart, a trade war. I mean, there's plenty of stuff to talk about that this housing is rolling over. I want to show that to you real quick. Oh, sorry. This is housing, guys. Okay? This does not look like a strong economy. I'm writing the quarterly report for the Premier people. And I'm talking about the economy versus the stock market and how they're different animals. You guys might feel good about the real economy right now, but the stock market's telling us we better start waking up, because the stock market looks 6 to 9 months ahead, and maybe if this keeps going down and kind of confirms a bear market, it's telling us that real people, average people in the real world that don't pay attention to the stock market, they're going to start feeling the pain in about 6 or 9 months. So they're different things. So that housing rolling over, that's another big piece. So that could be evidence of this is the top. And then we have the Italian debt. Let me show you that too. Where is that? Italian debt is like on the precipice. Look at this. Doesn't it look like the DAX, like the German market at Head and Shoulders? Breaks this. Something's happening over there in Italy. So we have enough of things in place. So we need to see now the technical stuff of the market to kind of confirm it. But I also have a case that, hey, we just come down here one more time, kind of retest this low down here from January, and we're off to the races, because leading indicators have not turned down yet. And maybe this month they will, but as of last month they did not. The yield curve inversion got better on this, because the spike in interest rates that I showed you last week that started, well, look at, you see how it turned up there? I don't know if you can see this. This is a monthly chart. See how it turned up? So it got further away from inverting. And then, like I've told you, did not get the sediment here in the office. Now, maybe we're doing a good job. Dad joked with me yesterday and said, why aren't the phones ringing? And I said, Dad, because your son's communicating well, and we took some action. So maybe my clients are smarter, and I hope that that's the case. And my clients weren't all, get me in, I'm only buying Amazon, all that kind of stuff. But usually tops have that euphoric kind of nature to it, where people are 80-20 portfolio, they want to go to 100. We got 60-40 portfolios, they want to go to 100. We got people that say, Todd, I don't need you, I'll put all my money in Amazon. We didn't get any of that. So, that makes this green possibility still on the table. I'm leaning, given the structure, that the top is in. Okay, but I'm maybe 65-35, something like that. So I want to keep an open mind. And what we may do with the cash that we built up, folks, if you see this happen, you're not alarmed. And the way the speed of this has happened, we could do it next week. But you see how we're expecting either a bounce or a new leg that goes to an all-time high around this level, around that support. We may buy a position back. The position we may buy it back, because in two things we have here. Either one, we're going to get a bounce up here that will be weak, but it will go up and retrace about 50%. We can make money on a trade like that, and then sell everything here in one shot and just be out of it. Okay, so we could actually make money on a trade if it was the red. But if it's the green, then we're back to fully invested to enjoy the all-time high. Okay, so if you do see us do something, know that we still probably won't be sure, because what we need to see what the bounce looks like. We need to see this wave come down and the bounce that comes after it. Now, another interesting thing, when you get the beginning of a bear market, the first leg down is usually about 15%. It's terrible. So that's why when they get the retracement rally back up and it gets back about 7 or 8%, people think, oh, it wasn't a bear market, didn't hit that 20% threshold, and they think the worst is over. And that's the feeling of what this is before this comes, and they say, oh, we're in a bear market. This is no good to know you're in a bear market when you're down 20%, folks. It does you absolutely no good. You might as well be thinking about buying at that point. All right. So if we can get off the top, within 5-7% of the top, 5%ish, then we have something to work with here, because then we have a lot of cash for the average bear market goes down about 30%. Okay. I won't talk about this week. I'll maybe talk about it next week. Remember, if you're out there doing your own, your home gaming out there with your own stocks, they do not love you. Amazon does not love you. Google doesn't love you. Netflix does not love you. The airline stocks don't love you. And I've showed you in previous webcasts, the average growth stock will go down 50% in a bear market. And I've showed you this in a previous webcast, so you know I'm not just making things up. I showed you Amazon. And it went down, I think, 60% in 2000, and went down another 67% in 2008. So you may want to be keying off us. Of course, you have Brian here at the office. He's a chartered market technician. He might be able to give you some guidance. If you have some individual stocks like that, you need some guidance. But if you see and you're following along with us, and even if we make a trade here, but you see us getting very aggressive and selling back out over here, you may want to take care of your personal stuff as well. You could always buy the stock back. And like I said, I'm working off historical stuff, historical evidence. No matter how good you think that stock is or how good that company is, it does not matter. It's going down 50%. The average growth stock goes down 50% in bear market. Okay, so you could be willing to take that risk, and that's fine. Is Amazon going to go up again? Probably. It's a great company, all this kind of stuff. But you have to be willing to take the risk that you took of all the gains, that you're going to have to give back about 50% of them in a bear market. So just be aware of that. Let me show you the 10-year note. So I think we've gotten this all squared away. For now, we're holding the 250-day. See how we broke the 200-day, but we held the 250. So that's interesting. I can't even tell you what I think is going to happen here. When we get into this volatile market, the micro kind of little squiggles, like I usually can maybe tell you, gleam into the next week. I can't here. I have no clue. Maybe we bounce up even a little more next week and then rip. Maybe we just rip down here. I don't know. So what I'm going to do is just kind of look forest from the trees here for right now. I simplified this chart greatly, and we're waiting for a bottom of this first wave down. It will be either this green one where we're going to new highs, or it's going to be the beginning leg of the bear market, and we're going to be getting off the train here. So we have a lot of time here. Actually, what I think may happen here, we may finish this off into October, end of October, and spend the whole rest of the year working our way back up. So that when we wind up in 2019, we get paid at the end of the quarter, right? But so does all Wall Street. Maybe we spend all this time working our way back up, right up to here, to the end of the year, so that we're still up on the year maybe slightly or something like that. That could happen. Yeah, that could happen, because we started January right in here. And if we wound up around 2,700, it looks like, and if we close at 2,800, all right, we're up 5% on the year. And that would be look good. But then next year is when, the real carnage begins. So that's kind of how I'm thinking into the end of the year. Finish this off into early November, and then we see the retracement into the end of the year, and we'll have to be gauging what that retracement looks like before we take further action. Now, the reason why, one of the reasons, all the other reasons I told you about, but one of the reasons was this 10-year note yield breaking out of this right here. This is too much for the market. It handled it early, and when we started surging in this last surge, that was it. The market gave it up. And actually, bonds sold off with stocks this week. They bounced up a little bit in these couple of days, but right here in the beginning part of it, they were selling off with stocks. So, but bonds still have a place in the portfolio. Remember, we reduced a little bit of that exposure as well, because look, yields are going up. That's bad for bonds, and we felt the stock market was getting weak under the surface. So that's why we did both. But we won't sell any more bonds. We'll probably hold what we have at this point, because my expectation is if this, I show here that this is going to do this too and still going to go up more, that would be the green on the S&P. That means the economy is super strong and healthy. Stocks are going to go up with interest rates, and that would be this more bullish count. But I didn't write this on this. I'm going to do it right now. This could have been the top in interest rates already. All right, because in order for this wave thing to work out, we had wave 3, wave 4. All we need for wave 5 is a new high, and we got the new high. So I could actually put that there. I am going to do it. Meaning that rates have hit their highs, and now rates are going to come down to test this neckline. And let me zoom out and show you what that looks like. I used to show it to you this way. Remember this one? Okay, so this is 2015, 2016, 2017, 2018. What do we tell you when you break out? You come back and test, right? Breakout, test, 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 test. Maybe we need another test, or maybe even dip a little bit into this. See all this resistance right in here, or all this support? And right down here at 2.5, 2.6%, I think that money's going to flow back into bonds when or if we're going into a bear market in stocks. Could they both go down together? Yes. But I think it's more likely we could see yields come in and test this kind of general area in here. And while it's doing this kind of testing over the next, 6 to 12 months, the S&P is coming down, and when the S&P bottoms, we get interest rates and the stock market to go up together, because we're going to have real kind of a global growth story like I showed you in that first chart. So like I said with bonds, is there a chance they both go down? Yes. I think more likelihood is that the stock market follows yields, and if yields go down or stocks go down, yields are going to go down with it, and bonds would be good in that environment, okay? So that's why we're going to hold on to the bonds that we have. We did a little pruning, but we're going to hold on to what we have from now, because if we're going into a bear market, it's going to provide protection. And if this was to occur down to here and then we rocket back up, okay, then everything is good, and I'm glad we sold a little bonds, because there'll be other stuff we could put in that will do better. All right, and it also means stocks are going up, which would be great, okay? But, my job here is a risk manager, okay? Above all else, and we saw risk, we've seen risk these last few months, right? We've been talking about it. We saw enough risk last week, we had to take some action. Now I'm giving you the real deal here, and, explaining what we're seeing here, so that we're prepared and we have a plan in place. So all that is very good. Now, this rising rates maybe is going to make the Fed hold off a little bit. Sorry, this report's long, but it needs to be today. If the Fed holds off, maybe that causes inflation to brew. Maybe the Fed does watch the stock market, okay? They are independent, they do. Maybe they said, hey, we got to slow up. I know Trump's been talking about that. The Fed doesn't care about Trump, but Trump may be right. But anyway, if the Fed eases off, it might have gave a little fire to gold, because gold had a little bit of a reaction this week to the upside. Also, there might be some inflation pressures building. We're hearing about this cost pull inflation, which is kind of bad when costs go up because of the tariffs, number one, and maybe raw material costs and things like that. But you can see here gold had a big day yesterday, and it got above these average. Look at how important these moving averages are. Stopped, dropped, resistance the whole way down. We broke out on a nice black volume. You see that? How high that volume was? This looks like a buy. Remember I told you last week we may hit one more new low, but we were comfortable holding it? Well, it looks like we didn't get it, and we got a strong reaction. Now, as long as gold holds above 1210 now, I think we're going to start going up. We bought a little high here. I think we bought up in here somewhere around in here. So we have a little work to do to get some money back. But this was a very good sign here, beginning stage of stuff. And I'd like to see this keep developing as we go forward. And we have the gold stocks as well. Did the same thing. And even today, they tried to go under. See, they tried to go under the 60, and it's going to close above it. So I like that. This is the HUI, the Gold Bugs Index, and it's